But I think the reality of the last 30, 60 days has proven to us is that from a security and risk perspective is that, we're not ready for like the next wave of capital coming in. Look, I think, is leverage good or bad? I think the financial system that runs today is heavily based off leverage. So I don't think inherently it's a bad thing. I think it's a very common thing across the stack. Nearly 10 years being in the crypto space, where we started really far away from what banks were doing internally for managing risk to being very close to what banks are doing with managing risk and compliance. I think the next 10x growth really comes from proving, one, DeFi is safe and secure again. Two, this growth of extracting away the complexity of using crypto and DeFi.
So welcome everyone to Beyond the Yield. Happy to have on board today Graham from Centrifuge. Hey Graham.
Hey Zygis.
Yeah.
I say it right, sorry.
Yeah, you're saying it right. A lot of people are actually struggling with that. So yeah, I'm Zygis, I'm leading product at DIA. And yeah, welcome to Beyond the Yield again. Happy to have you here. And yeah, maybe just to begin with, could you tell a short story about yourself, your background, and how you ended up working on DeFi and RWAs at Centrifuge?
Yeah, awesome. Well, firstly, thanks for having me. It's great to be on the Yield. Yeah, so I mean, I was really lucky. The way I started and got into the space is I worked for a bank in South Africa. Myself and a colleague, we were really passionate about the technology. This was back in 2016, and we worked together to get buy-in from the organization at the time to start the blockchain team there. And that was 2 or 3 years of just pure research into the ecosystem and the potential and the possibility of what could happen across the DeFi ecosystem. And DeFi really wasn't a thing back in 2016, 2017. It was only starting with a few players. And I think from there was obviously from there was understanding the opportunity, and that evolved me obviously staying in the space for a long time and moving into DeFi or a DeFi related role full-time in 2022 at Signum Bank, and then continually been working across the stack, worked at RWA along the time that they were building out Go, and now it's at Centrifuge, mainly focused really around RWAs. My role today at Centrifuge is the DeFi product lead. What it really means is that I mainly focus on how we can bring Centrifuge's tokenized products into the DeFi composability stack and really give these assets the same composability that we've seen in DeFi for the last 5 years, that it's been so exciting with governance tokens or stablecoins or yield-bearing stablecoins, and bring that really the same composability into the DeFi stack, which I think we're slowly starting to get there and really excited. And I think we'll talk more about it part of this conversation.
Yeah, we'll definitely speak more about it. What I find interesting is that you work close to both TradFi and DeFi, right? What did that teach you about, is there a gap between how TradFi is building products and DeFi, and if there is, how different is that when you compare, let's say, your experience, even though you were building quite some crypto stuff in TradFi, but still, I believe you got a touch of how different the space is still from the DeFi that we have now, right?
Yeah, 100%. I think the biggest thing and the biggest viewpoint, and we're starting to see it coming in today, let's say in the DeFi space, but in the TradFi ecosystem, the real focus is on risk, security, and compliance. That's a really, at the centerfold of every product that you're building within TradFi. You have different, in DeFi today, you're not really speaking to any regulators, or you're not answering mishaps to regulators, and maybe some teams are. But we're in TradFi, when working at a place like Signum or similar, is that they have regulators to answer to for customer deposits. And so the focus really, number one, is making sure that everything is compliant, and then number two is that and being compliant is a really complex situation, purely just because there's a whole real world banking system that underpins, compliance in a regulated ecosystem. And so it's how do you bring these DeFi products or crypto products, plug them into traditional banking rails, keeping them compliant and being able to report into the existing, central banking reporting systems that you need to report to or things like that. So it makes it a really, really challenging item. Number two is just like risk, right? I think when you're a bank and you're taking deposits, you have to have a very, very strong view on risk and potentially just have different, different regulatory requirements on the risk side of things. And so that obviously, in DeFi, risk is maybe just isolated to asset risk and smart contract risk. And so here, I think like it's very different. You can be a bit more, I don't want to say cowboyish, but you can be a bit more free in the DeFi ecosystem in terms of how you manage risk, and you can see how different teams win with the risk that they take and have lost in the space. So I think those are really like, I think the two things that taught me the most. And, like in TradFi, you have a slower delivery cycle that you potentially have in DeFi. And I mean, obviously the reason being that is really behind like these main things that you have to consider and build for and account into the building time.
Yeah, okay, super interesting. And you've already briefly mentioned that you've been kind of participating in, like you've been interested in the space at least since 2017, right? And also Centrifuge as an organization has been around since 2017. But you could say that only now we're seeing like a bigger adoption happening for Centrifuge specifically, right? So what do you think changed in the market or in the product that you're offering to actually allow this? Is it related to what you just mentioned, like maybe risk getting lower, more institutions putting more trust into DeFi, or is it just like that the product was not sufficient enough at the time and only now we see adoption happening there? So yeah, curious to get your take on what do you think leads to success now?
Look, I think I love this question because we were like super early when Centrifuge was super early, like you say, 2017. And the building out that we did over, 2017, 2018, 2019 as a team was early, but there was no demand for the product suites. So, like we were ahead of the time when thinking about bringing these real world assets on chain. But the big issue that was faced was this mismatch of demand and supply. And so we were bringing, but there was no demand for these assets and these products. And so we were really trying to experiment. We launched some private credit pools in 2020, 2021, 2022. But the biggest challenge was, one, that there were no interest, like the demand was really low. And number two was just that there was no, like it was difficult to compete with yield on chain for the retail, like the retail yield flow. So, we think about back to 2022 and DeFi summer. It was a great time to be around, but you were earning, yields upward of 10% and on USDC. And so to bring any real world asset at the time to compete with that yield and get any mind share on chain was really difficult. And I think we saw the shift slowly start to take place, when we saw on-chain yields tend to go lower than the T-bill rate in the US, the risk-free rate. And then I think you started to see more interest in how do we bring these RWAs on chain. One, that the yield is one aspect of it, but I also think a lot of teams, and we're big fans of Grove, which was one of the maker stars, showing that on-chain capital is looking for safer, stable, reliable yield. And that comes really driven through like these RWA assets that are coming on chain. We think about the treasury bills, but as well as, we have a AAA CLO, which really I think is that you're slowly starting to see the demand looking for diversification of yield for RWAs on chain. So that I think that's like the one pillar, right? Is that you have stable coins looking for yield. You have these institutional on-chain credit funds like Grove looking for yield. You have DAOs and DeFi protocols, sitting on idle capital, looking to diversify their yield into safer assets, which I think you'll see this continual grow of let's say RWA demand. And then I think you sit on the other side where, we at Centrifuge, we have some interest in tokenized equities, but some of our competitors have done a great job with bringing tokenized equities on chain. And I think that is like, it's opening up a new market to everybody, who's maybe doesn't have access in the countries that they live in to be able to access, Tesla shares or Apple shares or whatever shares it may be, but now they can finally access it through this borderless financial infrastructure that has been being built over the last few years, and then they can go and do the whole DeFi plug and play aspect of it. I think it's super exciting, and I think that's really like, I think the why we've seen this takeoff of RWAs in the last 12 months really start to take up. And I still think we're going to see, I always love referring to like RWA XYZ, and I think like 18 months ago TVL, the TVL from 18 months is up 3x or 4x over a year and a half time, which is, I think, a testament to not only what Centrifuge has been doing, but the whole RWA ecosystem in general, which I think is, it's exciting.
One interesting point you mentioned was about DeFi participants seeking for lower risk and thus investing in RWAs. Is this what you're seeing at Centrifuge? Is it mostly DeFi capital flying in, or is it also institutions trying things out? Like, do you see some investment banks coming in and depositing, or is it still mostly like DeFi capital being deposited that are just seeking for a safer yield, maybe compared to what we have in traditional lending markets?
I mean, I think from our perspective, it's on-chain allocators. We're not really seeing off-chain allocators move on-chain. And if they are, they're doing it silently, right? So it's not that like maybe they're still coming on and they're accessing like these products via their own way. It's really about I think it's, I would just say it's existing on-chain capital allocators just moving away from potentially 1 or 2 DeFi sources to including 2 or 3 RWA sources plus their DeFi sources. Like I'm sure we all grew up in, in Finance 101, where it was always like, always diversify your asset base and always diversify your investments. And I think we're seeing that start to play out with on-chain capital allocators diversifying across multiple RWA providers and multiple RWA assets and on-chain DeFi assets to have this like good basket of assets that sort of that will keep you protected and earning yield.
What do you think we are missing from bringing off-chain capital on-chain?
I mean, I think it's really tough, right? I think we just have to look at the last. I mean, not too sure when this will air, but when it does air, and like I'm sure there's going to be a lot more as well. But like if you just look after the last 60 days, and there are a number of hacks and protocol compromises, and the unfortunate event with KelpDAO, is that all those things will sort of will always bring hesitation for this other capital to move on chain, to really justify, the risk reward ratio for bringing this capital on chain. The challenges like DeFi is obviously, and I think unequivocally, like very clear that it'll win, right? DeFi will win in the long run. We're all moving towards this is like what I strongly believe in, is that like we're all moving towards a world that everything will be underpinned by the DeFi infrastructure. But I think the reality of the last 30, 60 days has proven to us is that from a security and risk perspective is that, we're not ready for like the next wave of capital coming in. And unfortunately, I think that like trust lever is going to sort of be, it's like really low at the moment for convincing capital to come on chain and make the most of things. But I would just preface it to say, I think is that it will only make us better. I think, I've seen it before and I've been through cycles where, we had a lot of hacks in these DeFi protocols, and what it just meant was that we spent a lot of time we spent a lot of time hardening them, re-auditing them, spending a lot of time managing risk. And I think the same thing will happen off the back of the last 30, 60 days is that, I can talk for Centrifuge, but, we're reviewing, we're like hardening, expanding the security infrastructure around like everything that we do. And I'm pretty sure every other single DeFi team is currently doing that now as well. And every DeFi protocol is reviewing assets that are maybe used as collateral or risk, and to ensure that, we're hardened, that it doesn't happen again. And I think building to really answer your question, then it's like rebuilding this trust. It's rebuilding that DeFi or on-chain is a safe place to park your dollars, to earn yield, to benefit from the composability rails that we all love. But it's going to take some time. I think that's a reality that we're all aware of. Maybe the last 30, 60 days is caused. But again, like I'm bullish. I think, you know, DeFi will win. Teams will come back, and we will have, I mean, hopefully in 2 years' time, when we have a follow-up conversation, we can just say that, you know, we learned a lot about this time, and it only made us better and stronger. And what end result meant that we brought way more capital on chain.
Yeah, that's definitely the goal, that we would take learnings from this rather than just, you know, forget about it and repeat next cycle. Yeah. So yeah, hopefully everyone is taking notes right now and reviewing their stack. And speaking about stack, we mentioned RWAs on chain quite a few times. Can you explain to someone who is not familiar, like how RWAs on chain really work? Maybe can you walk us through the journey of like how does certain TradFi market end up on Centrifuge, and then maybe like even in DeFi protocols? So this entire, like, what's the middleware that is required to actually bring these assets on chain?
Yeah, I'm more than happy to. So Centrifuge is a tokenization protocol. And what Centrifuge does, or what we do at Centrifuge, is that we work with the asset issuers. So some of our main partners is Janus Henderson and the S&P 500, as well as like Apollo, which is an enormous private credit fund. And what we do is we work with these asset issuers internally with our own asset manager by the name of Anamway, and we help them bring their assets on chain. What does that mean? Is that the Centrifuge protocol allows you to build a fund, essentially, which is essentially a vault infrastructure that allows these asset issuers to tokenize their assets. So, you know, create a share on chain that allows an investor to come in and purchase these assets. Now, what's happening in the background is, you know, the Centrifuge protocol facilitates these investments or redemptions, and then let's say, is built for RWA on and off ramping to the underlying providers to go and purchase the assets off chain. So there's an off chain component where you still have to buy the real world assets off chain, but the protocol enables this. Then you buy the assets off chain, and then you tokenize and issue the representation on chain by the Centrifuge protocol. And these are the primary assets. So like that's the flow for these primary assets that are only open to they're only open to non-US professional investors. When we think about like the DeFi assets, Centrifuge, we've also issued what we would refer to as DERWAs. And essentially, they're a wrapper or a debt instrument of the underlying funds that are primary funds. So we have 4 funds at the moment. It's JTRSY, which is our treasury bill fund. We have JAAA, which is our CLO AAA rated fund, Apollo's AA CredX, and then S&P 500. Then we have a DeFi version of each one of these funds, which is a debt instrument to the underlying fund, but allows you to, once you KYC and purchase the primary, you can then freely transfer it on the secondary market, which makes these assets really great for the DeFi ecosystem, because as an individual, you can come in, you can either acquire these assets on a deck somewhere, or you can KYC and be able to acquire them directly with us. And then you're able to then go supply them as collateral on Morpho, or borrow against it, or supply it as like liquidity on DEX, or just hold them as a savings product. So like you have this benefit and composability in the DeFi ecosystem via these assets. You're still getting the yield from the underlying asset, and then you're still being able to use them in the DeFi rails that we've come to love. So that's sort of how Centrifuge works. It's very vault-based infrastructure, really designed and tailored towards RWAs, and then being able to, once you've issued these assets, be able to then plug and play them in the DeFi composability ecosystem.
Okay, and why specifically these assets, and why they're taking off at the moment? Because I remember some time ago you were, as you also mentioned here, that you were trying to bring private credit on chain. And it seems that now you're more focusing on like assets, like yeah, as you mentioned, like treasury yields, you can call it ETF, I guess, as an NP 500, right? What you launched with the SPXA. So what's your, like, how does your process for evaluating which asset to bring on chain actually work? Is it driven completely by demand, where someone asks that, hey, we need this liquidity, and like, can you bring it on chain? Or is it someone else driving? So how you make these decisions on which assets you're bringing actually on chain?
At the end of the day, like, Centrifuge is a permissionless open infrastructure for tokenizing assets. So ideally, like, the thought is that anybody could come in and tokenize the asset if they want to, if you're an asset issuer, and we can support them with that entire process. The ones that we partner with, one, I think, is we're really focusing on high quality real world assets that are highly liquid, tradable on the secondary market. I mean, Polo's maybe a bit different. That is interesting to the market, that we know that there'll be demand for. There is demand for justifying us bringing these assets on chain. Now, when we think about 2017, 2018, well, I mean, it would have been more 2020 when we were doing private credit. We were trying to source the capital for the private credit deals, and it was very difficult to do. And we were trying to be this middle ground. Where today, where our focus is partnering with somebody like Apollo, who's one of the biggest, or if not the biggest, private credit fund in the world, and then that manage and work with these kind of partners to bring these assets on chain. So I think that's really the big difference and what we're looking at. And I think it's just like a yield and a trust lever kind of thing. We work with Janus Henderson, which is one of the biggest, also again, one of the biggest asset managers in the world. And so these are the things that we're really wanting to focus on. And I think that's really like where we spend a lot of time and effort in, is like helping great asset managers wanting to come on chain and tokenize their assets, and then making sure that we have demand to supplement these assets that do come on chain.
Right. And you already mentioned that Centrifuge's assets are starting to be adopted even by lending markets like Morpho. I saw also like recent integration with Euler. There's other institutional market also for lending these assets. So what do you think DeFi enables for these RWA assets, what TradFi maybe is not capable of enabling? And like, how does this entire lending market like play in this entire RWA space?
It's a hard question to answer. I think when we look at, maybe not so hard. I think when we look at these RWAs that either retail institutional holders are using, depending on their needs and on chain, let's say their needs and the reason why they access these. I think, if you're a retail investor and you're used to looping specific assets, coming in and holding an RWA asset now that potentially you can loop to get additional yield. I think like that, it's like very native to those users, and the infrastructure is there that's built to allow them to do this. I think that's like that's really answering a need and a use case for what they potentially wouldn't be able to do with their broker account, or their broker account is too cumbersome to be able to do such a thing. And so, like we're all potentially, these DeFi native users have the ability to do it, and the infrastructure rails or the vaults that are built on top by specific curators allows it to be done. And I think that's really maybe the one reason. And I think when we're thinking about these users, is that they're also on-chain allocators, and so they want to be using the on-chain like rails to put like the assets to work. And I think that's really the focus there, as to why they would do it over potentially using a brokerage account or something that they would have access to already today.
Yeah, makes sense. And you briefly mentioned looping, which is really interesting in today's context. We just saw how KelpDAO made the situation that all the loopers were stuck in lending markets, right? Like you couldn't unloop basically, and then as the yields grew, it became unprofitable. And overall, looping sounds like risky strategy to pursue. It's eventually you're putting leverage on your positions, right, to earn extra yield. So first of all, do you think looping is good or bad for DeFi? And then how do you think we should how can we ensure that it doesn't lead to like a huge and leveraging event potentially in some like further future when the markets hit much larger TVL numbers?
Look, I think, is leverage good or bad? I think the financial system that runs today is heavily based off leverage. So I don't think inherently it's a bad thing. I think it's a very common thing across the stack. I think what CalpDAO maybe showed us, and I think I talk about it like the learnings, was the risk that it introduces into a banking system, right? And I use the banking system as, on-chain DeFi, be it Aave or like whatever the related counterparties were to what happened. So no, I don't think looping's a bad thing. I think looping's a natural, organic financial product that gets driven out of the fact that individuals can derive more yield from it. With leverage, obviously introduces more risk, and maybe the traditional finance ecosystem has dealt with how you manage these risks via financial crises that sort of get driven out of when leverage in the financial system needs to be deleveraged, and obviously they have their own issues there. So I think really when we think about leveraging today is how do you manage risk with these assets for the leveraging, and this is where you could I don't really want to get into the argument or like discussion point between like what makes Aave good and what makes Morpho good, but it's a great example of Morpho's infrastructure where you have this like isolated risk to a specific vault in the looping strategy, which is somewhat contained from a risk perspective. And I think you'll see with Aave v4 and these kind of products will move to a more risk isolated ecosystem where the risk will be very siloed to that individual market, and when you supply your capital as just an LP, maybe you're not leveraging, but you're adding your capital there. You have to understand the risks that you're adding into that vault in itself. That you sort of put your capital at risk for a looper to take leverage of it, and I think you need to be aware of those risks. And I think there's enough risk disclosure today to be aware of it. So yeah, I mean that's my answer to the question. I think it's tricky, but I definitely think everything lives on leverage today, and I think looping is an important growth lever for a lot of products, but it also generates more yield. And when the minute there's more yield, there's going to be more leverage in place.
Yeah, I was listening this week to a podcast by one of the best macro investors of our generation, and he was telling a story where like basically every crisis in the world came because of too much leverage in the system, which unleveraged, right? So this sounds like a potential future leverage point which could build up, and which would cause like a huge unwind.
Yeah, and look, whatever happened with CalpDAO, right? I think today we can look at DeFi United, and it's incredibly impressive that in its own way, it's had its own, I don't want to call it bailout, but a bailout in its way. And DeFi will continue, right? And, I believe that over the long run, like Aave and, just from a pure revenue point of view, will be able to repay back all these people. It might take a few years, but like they'll get there. And I think, it's great to see the recovery that will take place outside of this and the continued growth that'll come in the DeFi space. But yeah, very true about the leverage.
Yeah, well, like if you look at Visitation, like the deleveraging event that we just had, like isn't even caused by like too much leverage. It's caused by a hack, right? Like which is completely different case. And as you mentioned, like when we start dealing with our risks better, then maybe we can have like a bit more leverage in the system also added. Cool. Like so, as of lately, we've seen, of course, growth in RWAs in terms of like users adopting treasury yields. As you mentioned, stocks are growing. What do you think will be the next big unlock in RWA space? Like, what will be the next RWA instruments that protocols will push, or that users will be mostly interested, like maybe some bonds, the same private credit, maybe it didn't work so well in the first time, but maybe the market is different now and like eager to get juicier yields. So yeah, like what's your view being inside the RWA space on where the next growth verticals are potentially lying?
Again, I think it's a tough question to answer, because I think maybe 3 months ago I had a different answer to the answer today and where we are with risk on chain. But I think the RWA ecosystem in itself is moving in the right direction. So like the 10x growth, I think is a big focus. Is the more we continue to bring high yielding assets with a very low, with high liquidity, like high secondary market liquidity in the real world, with very short redemption windows, will then obviously be heavily, like that is like heavily focused on, I mean, just like I think it'll be heavily focused on continue to do this. This is like where the access to capital will come in. This is where, can I re-answer this question? Maybe this is the only one I want to re-answer, the 10x growth one.
Okay. Yep. That's okay.
Sorry.
That's cool, yeah.
I can just go, or do you want to ask it again?
Yeah, I can maybe ask again for reference. We'll see like which part, but okay. So being an insider in RWA space, like where do you think we are going next? Like we've been bringing treasuries, we've been bringing stocks, right? Like what's the next growth vertical in RWA space that we are likely to see?
Yeah, I think the assets will stay somewhat similar that will be brought on chain. I think it'll be more equities. I think U.S. treasuries are here. There are Centrifuge. There's BlackRock. There's a few others. There will be more variety of interesting assets that will come on chain that are higher yielding with a bit more risk, but still the same. Maybe T1 liquidity kind of window. I think they'll get some adoption. Where I think the 10x will come in will really be around, one area I see is DeFi diversifying its yield, generating yield from assets that are RWAs. And you can see this with I think Morpho V2 with their fixed yield, or like the yield feature that they have. Aave V4 has this idle capital repurchasing feature that can go buy, yield-bearing assets underneath to generate yield for unutilized assets. And I think that'll be one growth factor, is like DeFi seeking or powering some yield outside of their stack from RWAs. That's one area. I think that the other area is I think it's just retail looking for savings products, safe savings yield. And I think, there are so many great, fintech retail product plays that are coming up at the moment. And, you see them all over X, like be it like Avicii, or be it the Plasma One product. All of them are going to need to diversify their yield from a risk perspective. And I think, RWAs is going to be a very interesting or natural opportunity for them to diversify into that space. And I think we'll see some growth there as well. So I think it's, a variety of things. It's better assets. It's going to be, more liquidity. It's going to be, maybe it's some regulation, but I also think it's like better distribution. I think like today, what excites me about crypto is the distribution venues that are sort of being built out by these fintech app kind of style products that are offering yield to the users on stable coins. And I think that'll really help the overall growth of RWAs on chain over the next 6, 12, 18 months. Where we get 10x growth from, I don't know. I'm also very interested to see what that looks like, I guess, in the next little bracket that we're focusing on.
Interesting that you mentioned like the new fintechs as so-called neobanks, I think, right? Which are popping up right now. Usually these we see, at least on centralized exchanges, they just earn 5% yield on USDC, and that's it. So they abstract all the logic behind.
Yeah.
How do you think like ideally a neobank should manage their risk and how they should distribute between, like, investing in yields, but for example also like in some crypto markets, right? Because probably the yields might be higher or went into looping. So like, how do you have an idea of how this can be mingled together between like the DeFi yields and the TradFi yields or RWA yields to make it like more composable finance?
I think these fintech neobanks will end up doing exactly what banks are doing from a risk department point of view. So if you think of in traditional finance, there are all these deposits that come in from depositors, and then there's a very big credit team in these banks that obviously, the bank needs to generate yield on these assets and are lending them out. And in the same way, in these neo fintech plays, an Aave is if you're depositing some of your users' assets into Aave, like that, you're extending a credit line to Aave in a way to generate these yield for your users. And if you were in a bank, if you think about it, any, tier 1 bank, wherever you are in the world, that bank isn't lending out all customer deposits to a single person generating yield on those assets, right? Which would be irresponsible from a banking, or it wouldn't be allowed from a banking regulation point of view. And I think these fintech neobanks are going to sort of merge very close to what a credit team is doing at a big bank in terms of managing risk, reviewing protocols, reviewing liquidity on the protocols, reviewing the contagion risk of a cult DAO happening again, and what does that mean for the users and their USDC. And I think it's gonna what I love always is that over the last nearly 10 years being in the crypto space, where we started really far away from what banks were doing internally for managing risk, to being very close to what banks are doing with managing risk and compliance in all these crypto products that we're doing, right? It's like so focused on evaluating so much of the risk and contagion and managing customer deposits and making sure that it's diversified, that if something does go wrong with one venue, that you're not you're not losing all your money, right? And managing that across the board. And I think all these fintechs are going to end up really getting close to what a bank's credit team is doing to manage risk.
When you tell it, everything so makes sense that, yeah, this is the great wave of replacing the banks with a more efficient system.
Yeah.
Okay, what's next for Centrifuge? Is it more assets, more liquidity, maybe more chains? Like, what do you think will be the next growth pillars for the Centrifuge as a protocol, right? Like, where do you see most growth potential? Yeah, just in general, what can we expect in the next, let's say, until the year end from you guys?
I think there's two pillars. So one, really focused on continue bringing high quality assets to the market via high quality asset managers. We have one announcement that should be coming out in the next month or two, another high quality asset manager bringing these assets on chain, and continually working with our existing asset managers to continually grow investments in their products. Really big focus. We'll continue doing that. We have, I think, the best suite of real world assets on chain today for an investor. So I think really focusing and building those out. On the other half is that, Centrifuge, we're a tokenization protocol that allows any asset manager to come in, or any team to come in and tokenize their assets. Great example is a partner of ours called Daylight, who are using the Centrifuge protocol to tokenize the assets that they're looking to distribute into the market. And I think that is a big piece of our focus, is continue bringing participants who want to tokenize some form of real world asset, or tokenize, I would call it, an on-chain fund via our white label solution that we're offering in the market, and distribute that into the market. And those are the two big focuses that we're working on. So one is more on our assets and bringing our assets on chain, but also allowing other teams who want to leverage this technology that today is securing nearly $2 billion of TVL in real world assets, is allow other teams to benefit from that same technology stack that we've built, to allow them to grow their asset base and them to grow their access into the distribution in the market that we can the protocol itself provides. So two very different but very exciting things that we're working on. I think we'll continue to grow that over the next 6-12 months.
Okay, super interesting and excited to see all this being deployed on live. What and like we briefly touched on regulations, so maybe just like wanted to go just a bit into this. How do you view regulation as a whole? Like, of course, you're dealing with RWAs, you're sitting closest to regulations, and what's your process of evaluating, like, is this regulatory friendly? Is this not? Is there overall enough clarity in the space on like how to tokenize RWAs and what can you actually do with them? So yeah, maybe you can expand on this.
Yeah, it's a question I can't really answer. It's really one for the legal eagles in the team to really focus on and answer. I can only say from like a high level point of view, I think we all know that regulation needs to evolve to cover more on-chain assets. We do know now today that regulators all over the world are paying attention and building and discussing frameworks and some kind of regulatory acts in each of their countries to enable this. And I think the right people are having the right conversations to drive the space forward with the right interests. And so I think we just have to wait and see.
Okay, yeah, thanks. It makes sense. My final question would be, what do you think is missing from DeFi to achieve the next 10x growth in terms of users, of whether it be retail or institutional? And it's not only in RWA space, but of course, like you're coming from the space, so I would expect you to have some opinion on that. But just as a whole for DeFi, right? Like, what are we missing to get the next huge chunk of growth?
I think I've touched on it a lot, right? Obviously, we're maybe down 5x from the last 60 days, just behind all the hacks. I think the next 10x growth really comes from proving, one, DeFi is safe and secure again. Two, this growth of extracting away the complexity of using crypto and DeFi, so this UX layer there. And then, I think those two will really be the biggest pillars, right? Because I think those two are going to be the catapult. Is one, making sure that everyone trusts on-chain finance again, and that your capital is not just going to be withdrawn or locked up or have some issues or get hacked, I guess, from the protocol point of view. And then number two is just, I am really excited about it. This is why there's so many of these neobanks popping up, fully focused on cryptos, that I think it's going to be so great to extract away all the complexities that we face today in the crypto product rails and really just giving everybody a really easy access into the market. So I think that's really, the focus.
Great.
That's where the 10x growth comes from.
Yeah. Let's hope this all happens in the next cycle or a couple of cycles. But hey, thanks Graham for jumping in. This has been great. Maybe you can tell us more. Where can we follow Centrifuge? Where can we find out about the news? What's the best medium?
I mean, X is probably the best place. You can go follow us on X. We sort of will announce everything via there. You're always able to see more information about the Centrifuge products on our app, which is app.centrifuge.io. You can then also view our reports on June. There's a Centrifuge dashboard or RWA XYZ. You can also see everything there around Centrifuge. There are a lot of places to be able to access the information. But those are maybe the main ones I would recommend.
Amazing. Well, thanks for joining us on Beyond the Yield. It was a pleasure having you, and
thanks so much
have a nice week ahead.
Yeah, you too. Thanks.